Hello, welcome back to Trust TV. I'm Marcus De Silva. Welcome to the studio today.
Thanks for having me.
How would you persuade investors to stay in the active, not the passive space after recent issues with certain staff fund managers?
Yeah, it's a very topical question. I think for me, in the equity income space and in the value space, active fund management has a very key role because a lot of the sustainability of dividends is based on the future outlook for a company rather than just the historic financial metrics. And so, passive investing can be very good at just identifying financial metrics that are attractive, but it can't really look forward into the future and see where the issues are and where industries are changing. And I think we've seen in the UK. There's enormous amounts of change going on within areas like media, in areas like resources, oil and gas. And so I think where active comes in is in looking forward to seeing the sustainability of the business models, which is something that's hard to do from a passive point of view.
Given this low interest environment will be here for the foreseeable future and there's lots of money printing, to what extent do you think equities will outperform other asset classes like gold, bonds and property over the next few years?
As an equity investor, I always have to say they're going to outperform. I think from where we've come from over the last decade, it's going to be hard getting real returns from some of the other asset classes that you mentioned, because we do have a moderate level of inflation, between 1.5% to 2%, and we all know that. And so actually, if you're investing in bonds at 1% yields, it's going to be hard to make a positive return. I think equity markets will provide an active return for those who can take volatility, and I think that's the key part for anyone watching this. In the asset mix that you choose, you'll get higher yields from equities at the moment. You get the potential for growth and exposure to capital growth, but it will expose you to volatility. So if you can take that volatility, I think there will be a good total return vehicle for the medium term.
Dividend cuts are an anathema for income investors. What warning signs, triggers of possible cuts do you look for in your analysis?
The most important one is balance sheet strength. So when a company is operating with high leverage, it makes it less flexibility for them to react to changes in the environment, changes in economics, changes in the competitive situation. And it also, I think, which people have underestimated, makes it less possible for them to invest in the future and change. And so the ability to invest is key because business is changing all the time. So what the key things we look are at balance sheet strength and investment needs, because the two of them go hand in hand.
We'll see you next time. Goodbye.